In this segment, we're going to talk about what limited liability actually means and why protection only works when the business behaves like a business. Most people think limited liability comes with the filing. They hear the words and assume it's automatic. Like once the paperwork is approved, the protection turns on. But limited liability is not automatic. It's conditional. So today, we're going to talk about what limited liability actually means, why it can disappear, and how business behavior decides whether or not it stays. When people hear the phrase limited liability, they picture a wall. They imagine the business on one side and their personal life on the other. They believe that the wall exists merely because the business exists. But the wall isn't built by the filing. It's built by conduct. If you open an LLC today and run everything exactly the same way you ran it before, the wall never forms. You can't claim separation that you never created. Understand that separation is created by behavior, by conduct. And here's what the law is actually watching. It doesn't watch forms, it watches patterns. It looks at how the money moves, how decisions are made, and who is acting on behalf of whom. If every decision still goes through you personally, the business is just a name. If the business doesn't act like it exists, the law treats it that way. Separation is the core requirement for limited liability protection, for maintaining limited liability protection. Limited liability requires separation. It means the business has its own life, its own money flow, its own obligations. If you borrow money personally to cover business costs without documentation, the separation begins to collapse. If personal expenses come out of the business account without explanation, the line blurs. Once the line blurs, the protection is weakened, and single owner businesses are more scrutinized. They don't get less protection, they just get more attention, because when one person controls everything, separation has to be proven more clearly. If the same person owns, manages, pays, and benefits, the business has to show discipline. Discipline replaces distance. Discipline replaces distance. When limited liability fails, the business is treated as a personal extension, not because of one mistake, but because of repeated behavior. Remember, courts look at patterns, small shortcuts. They add up. Messy records adds up. Unclear roles add up. Protection doesn't disappear suddenly. It's going to erode over time as a result of those behaviors. In order to maintain protection, limited liability protection, it requires consistency, intent, and respect for the boundary that you created when you formed the business entity. When the business can't stand alone on paper and in practice, when the business can stand alone on paper and in practice, the law respects it. Limited liability is not a promise made by the state. It's a result earned by behavior. In this segment, we're going to talk about operating agreements that people never read, but courts always do, and why this one document decides whether your business, your LLC, is real or whether it's just a name. Welcome to the Prosapreneur Network. Most people think the operating agreement is a formality, something you download, sign once, and never look at again. But for an LLC, the operating agreement is not background paperwork, it's the actual rule book. Today, we're going to talk about what an operating agreement really is, why the courts depend on it, and how silence inside that document creates problems later. So, what is an operating agreement and what is it supposed to do? An operating agreement explains how the business exists, who owns it, who controls it, how decisions are made. When someone asks, who has authority here? The operating agreement answers that question. Without it, the state answers for you. Why do people skip reading the operating agreement? Well, maybe because nothing seems urgent at the beginning. Everyone agrees. The money is light. Problems haven't shown up yet. It just feels like something to worry about later. But courts don't apply rules based upon when the problems felt urgent. They apply the rules based upon what was written. And here's what the court looks for inside of the operating agreement. The courts use the operating agreement to understand the reality. They want to know how power is divided, how the money is handled, and how disputes are resolved. If the agreement says one thing, but the behavior shows another, behavior gets questioned. An operating agreement doesn't just explain intentions, it sets expectations. And single member LLCs need them more. Single member LLCs are not exempt from structure because when there's only one owner, the agreement proves that the business still exists separate. Without the operating agreement, it becomes easier to say that the LLC is just a person in another name. Writing rules for yourself still matters. And when the operating agreement is silent on an issue, when the agreement doesn't cover something, state law steps in and fills the gap. And state law does not know or care about your intentions. If there's no rule for disputes, exits, or money, the state uses its default rules. And here's the thing about default rules. They rarely match what people think is fair. So, the operating agreement, it's also there to support limited liability. The operating agreements support limited liability by showing discipline. They show planning, consistency, and respect for the business. When decisions match the agreement, the business looks real. That makes separation easier to defend. Ignoring the operating agreement doesn't make it less powerful, it just makes it quieter. Welcome to the Prosapreneur Network. In this episode, we're going to talk about capital contributions nobody documents and why undocumented money makes business protection fall apart. Welcome to the Prosapreneur Network. Most businesses don't fail because they run out of money. They fail because they don't treat money carefully. Today, we're going to talk about capital contributions, not as paperwork, but as proof. Because the moment money enters the business, separation gets tested. Let's talk about what capital contribution is. A capital contribution is money or property put into a business to help it operate. It's not a loan, it's not income, it's ownership going in. So when an owner deposits personal money to get the business started, that's a capital contribution. And that moment matters. So why don't people document it if the moment matters? People skip documentation because the money feels personal. It feels like helping yourself. They think it's my business, so it doesn't matter. It matters because the business is supposed to stand apart from you. Undocumented money blurs ownership. And when ownership is unclear, when the money is unclear, it moves without records and confusion follows. And the courts are not going to guess what the money was meant to be. Was it a loan? Was it income? Was it reimbursement? If no one can tell, then the risk increases. And as the risk increases, confusion abounds and weakens the separation. So remember, these conversations are all about liability. So what effect does capital contributions have on liability? When owners fund businesses personally, the business looks independent. It starts to look like an extension of the personal finances. That makes it easier to argue that there's really no real separation between the owner and the business. Because remember, protection depends on clarity. So what's the difference between a capital contribution and a loan? Well, a contribution increases ownership and a loan creates repayment. So if you expect the money back, it should be documented as a loan. If it's ownership money, it should be documented as ownership. Intent doesn't matter if the paperwork is silent. So, how does documentation support the structure? Documentation supports the structure by telling a clean story. It's going to show the life of the money from beginning throughout. It shows when the money entered, why it entered, and what it became. Clear records help the business stand alone. That's how protection survives. So, money without paperwork doesn't disappear, it creates questions. If you're listening and realizing that this isn't about paperwork, it's about patterns, well, that's intentional. Behavior leaves patterns, and most people never see them until something breaks. If you already have a business operating, I built a business structure diagnostic that shows how your business behaves across separation, authority, drift, stress, and continuity. It doesn't tell you what to do, it shows you what's happening. It's linked below. Now, let's keep going. In this episode, we're going to talk about payroll and contractor mistakes that destroy protection and why paying people wrong turns business risk into personal risk. Welcome to the Prosapreneur Network. Most business owners think payroll is just an accounting issue, something the CPA handles, something software takes care of. But how you pay people affects liability more than most contracts ever will. Today, we're going to talk about why worker payments matter legally and how common shortcuts create exposure and why mistakes here, well, they don't stay small. So why do people feel confident about paying workers? Most owners don't set out to do this wrong. They trust what they see others doing. They follow advice that sounds simple. Someone says, just 1099, and that becomes the rule. But labor rules don't care what sounds easy. They care about reality. So it's important to understand that employee versus contractor is not a label. Calling someone a contractor doesn't make them one. The law looks at how the work is done. So if you control the schedule, the tools, and the process, the worker looks like an employee. If the person works mainly for you and follows your rules, labors don't matter anymore. Mislabeling workers doesn't hide the risk, it just creates evidence. And did you know that labor mistakes can reach your personal assets? And that's because labor problems don't stay inside the business, because wage laws are enforced aggressively. If the workers aren't paid correctly, liability can stack. Owners can be held responsible when businesses ignore the labor rules. This is one of the fastest ways limited liability gets tested. Payroll, taxes, and control. The courts are always looking at those things. Why? Because payroll is going to show control. Who pays whom? How often? And under what authority? Tells a real story. If the wages are late, undocumented, or mixed with personal money, separation weakens. So you're trying to build a business and the revenues are not there, and so you use personal funds to make payroll. How does that money get into the payroll? Was it a capital contribution, or was it a loan? Or was it documented at all? Disorganization makes it look personal. Shortcuts may feel harmless when the money is tight. Paying cash, delaying paperwork, guessing classification. Those decisions pile up quietly. When disputes arise, every shortcut becomes a question. So, how does paying people properly support protection? Paying people properly isn't just about compliance. It shows that the business operates independently. Clear payroll records support separation. Structure shows up in how people get paid. People are not paperwork, and mistakes here cut deep. In this episode, we're going to talk about banking under the wrong entity and how one account quietly breaks separation. Welcome to the Prosapreneur Network. Most people think that opening a business bank account finishes the job. They feel relief. They think that the dangerous part is all over. Remember, formed that LLC and then went over to the irs.gov website and got the EIN number. And so that last and final step was to go and establish or open the business bank account. So that's where we are. But a business bank account doesn't create separation. It only reflects it. So today, we're going to talk about how banking works legally and why using the wrong account creates exposure and how money movement tells the clearest story of all. So here's why banking feels like the last step. It feels official. Once money moves through an account with the business name on it, people assume the business is real in the eyes of the law. The checks have a logo, the card has the company name on it, but the law doesn't stop at appearances. It's going to watch behavior. So, what is a business account supposed to do? A business account exists to keep business money separate. At a most basic level, it is going to, or its purpose is to create a separation between personal expenses and business expenses. It creates a clear trail. Income comes in, expenses go out, all tied to business activity. The account doesn't protect you if it's used like a personal wallet. That's what's meant by mixing personal expenses with business expenses. And so let's talk about some of the common ways that people use the wrong account. Most mistakes here, they aren't intentional. People move fast, cover expenses, they fix problems quickly, paying a personal bill from the business account just once, depositing personal funds without explanation. Each time that happens, separation weakens. I think that one of the reasons why courts care so much about banking is because money is hard to argue with. Courts follow money because it shows what's real. If money flows freely between you and the business looks less independent. That makes it easier to say the business exists on paper only. What about multiple entities being operated out of one account and the problems that creates? Some owners run multiple businesses through one account. It feels efficient, but it mixes responsibility. If one business has a problem, every dollar in that account becomes a question. Separation can't exist without separate paths. So, how is proper banking supportive of limited liability? Well, proper banking reinforces structure. When the money stays where it belongs, the business stands on its own. That's what protection actually looks like. So, a bank account by itself is not protection, it's evidence. And in the next episode, we're going to talk about the phrase, my CPA says it's fine, and why tax advice doesn't replace legal structure. Money always tells the truth. Make sure It's telling the right story. And thank you for joining the Prosapreneur Network. If this episode helped you see structure differently, here's how to go deeper. If you're before launch or early, there's a business structure assessment. It helps you determine whether your structure is ready before complexity sets in. If you're already operating, there's a business structure diagnostic. It examines how your business behaves under review. Not documents, but patterns. Both are designed to give clarity before you try to fix anything, because behavior leaves patterns. Links are below. Use the one that matches where you actually are.